Everyone, and welcome to another edition of the Smart Investor Podcast. And in today's episode, we're going to explore the topic of complacency versus fearmongering. The markets are up. The market has been rallying for the last couple of years, and there is complacency creeping into the market, and you have folks that warn people about the effects of a decline in the market, and some people dismiss it as fear mongering. So we're going to look at those two topics here. We're also going to take a look at the different markets. We have some very interesting movements in the markets where we had a drop in the S&P 500 last week, followed by a recovery, followed by another drop. And for the week, the market ended slightly to the downside. So we're going to take a look at the technical picture of this rally to see exactly what's happening. We're also going to look at gold, crude oil, S&P 500. We are going to just do a comprehensive look at the different markets. But first, let's take a look at the S&P 500. The S&P 500 was down slightly on the week, and it saw what we are seeing here is a rounding pattern here on the S&P 500. And for those of you who want the video analysis of this podcast, you can go to smartinvestorcentral.com and look on market updates, and you'll get to see the video analysis. Okay, so we have the S&P 500 in this rounding situation here, and what we were looking for is support to hold at around the 2541 level. So support is at 2541 and resistance is at 2594. If we see the market going below the lows here at 2541, we could expect a greater sell-off into the 2475 or 2500 region for the S&P 500. So keep that in mind. If the market does clear resistance, the next it will be an all-time high, and the next psychological resistance area would be up at that 2600 region. Looking at the Dow Jones Industrial Average, chart positioning and chart pattern pretty much similar to what's happening with S&P 500, where the market ended the week slightly to the downside, and we are finding that 23,600 level is providing pretty strong resistance. That's a psychological level. The high was 23,602, and the market immediately backed off of that level. So it is a resistance in the market. Medium-term support in the Dow is down at the lows here at 23,242. A drop below 23,242 could open us up to 22,800 or 22,600 here on the Dow. Looking at overseas markets, we are seeing that the German DAX pulled back last week also. This was after the week before we saw a pullback in the German DAX, and the market is coming down into this 12,800 level. If we close below 12,800, that could open the door down to 12,005 or 12,000 on the German DAX. Bear in mind that this market is also at all-time highs and is looking very positive for the last couple of trading weeks. Looking at the FTSE. Now the FTSE, we have a different situation where the market has found resistance. The high in the FTSE was made all the way back in May. So in May we had 7,598, and the market hasn't traded up to that level since then. And we see a consolidation pattern here in the FTSE. You can see I have drawn on the chart. So support is down at 7,350 down to 7,300, and resistance is up at the 7,600 level here on the FTSE. But all in all, world stocks are moving to the upside. Let's just take a look at the volatility index. The volatility index is is not at historic lows, but it's near historic lows where the market volatility is down at 11. Just taking a look, the lowest volatility just before this 2008 market crash, the volatility was much higher than this. So the volatility is very low historically, and going at that 11.43 level, and it has to do with the complacency I see creeping into the markets, and we're going to explore that topic. But first, let's take a look at the gold market, where positive price action happened last week, and gold finished firmly to the upside, closing at 1,294. And I keep saying this, but I believe gold bottomed. The bottom in gold was made in 2015, 2016. And the reason I say that is because the chart positioning is telling us that, as opposed to folks guessing. Because I remember people were recommending buying gold during this decline in 2013, 2014, 2015, when we saw a series of lower highs and lower lows in the gold market. Let's taking a look at the daily chart. We were in the midst of a downtrend, and I constantly heard advertisements on radio and on TV that gold is a good buy, gold is a good buy. And the market ended up going down from 1,800 all the way down to the 1,050 level. So we saw almost a 50% decrease in the value of gold during that time, and a lot of investors got burnt. But at this point in time, we have seen a shift in the momentum here with gold. Notice that this series of lower highs, lower lows has been broken, and the market has now shifted, and we see a series of higher highs and higher lows. It's not trending aggressively to the upside at this point in time, and that's how bottoms form. The market's a base, and that is what I believe is happening here in the gold market. So we're up strongly last week, and resistance in gold is up at 1,310, and pretty strong support is at 1,260. If we close below 1,260, that will open up the 1240 level. And if we close above resistance in the 1310 region, the next area of resistance is 1,360. So this is a market that we're going to keep a close eye on over the next couple of trading sessions. Taking a look at the US dollar index, US dollar index was down last week, where we saw a move up in gold, and we could see the US dollar index go down to support in this 93 region, and at long-term support in 91. 91 is huge support, where we saw the market bounce earlier this year. Resistance in the US dollar index is up at the 95 region on the index. Bear in mind that US dollar index is still it's still near very strong support, and this market could be bottoming. And what we're seeing is conflicting signals with gold and the US dollar index. Can gold rise and the US dollar rise? Yes, it has happened in the past. So we're just going to keep an eye on what the dollar is doing at this point in time for some more clarity. Looking at crude oil, and crude oil was down slightly last week, but this is after a couple of weeks We have 5 weeks of pretty strong gains. And I believe oil also has bottomed out and bottomed in 2016. So we more than likely have seen the bottom in the oil market. Obviously, stuff can change and the markets can shift momentum, but the momentum right now in the oil market is to the upside. Strong resistance is up at $62, the $62 region. We're currently trading at about $56. Medium term resistance at 58 and support will be down at the $50 region. So crude, this is a market that we are going to keep an eye on, because if you're looking at the chart, and again, you can go to smartinvestorcentral.com to get the video analysis of the podcast. This downdraft that was made in the financial collapse of 2008, the market bottomed near this $40 region, and we see that the market again hit that region and bounced. So this area is pretty strong support in crude. This $30 to $40 area is pretty strong support. Notice that the market did briefly go below 35 or so, but the market quickly snapped to the upside. Looking at crude and the heating oil, etc., we could see further moves up in the market, but I suspect that we may get a pullback. We may get a pullback into this $50, $52 region. That is definitely positive. That's definitely possible. And if the market does pull back into those regions, it could be a good idea to be looking to buy the dip. Okay, taking a look at another commodity that has been on a tear recently is the copper market. The market is in a steady uptrend, and this could be one that has a lot of upside potential. And this is a market we're going to keep an eye out on, because remember, stocks are up now, but at some point in time, the luster of the stock market will go down, and it's a good idea to diversify your holdings across different asset classes. Oftentimes, investors are just in stocks alone. So when stocks go down, they feel the brunt of the decline. And speaking of that, let's get into the discussion about complacency versus fearmongering. Now, I put together a report about a decline in the Dow. The report speaks to the fact that a decline can happen in the Dow. The report doesn't say definitely the market will decline, but what the report says is that investors should be cognizant of the fact that the market can decline. And why I put together that report is because I noticed, just speaking to a lot of investors, sometimes I like to go on online forums amongst investors just to get the pulse. I read newsletters about the market, and a lot of folks are very bullish, and when folks get very bullish, they get complacent and they start to pour money into the market. In front of me, I have a chart of the Dow, and in 2008, 2009, 2010, 11, no one was pouring money into the markets, but now the markets are going up. It starts to hit the news cycle that the market is going up, and the perception in the mainstream and just speaking to the average Joe is that the market is on a tear, and that's when you get a lot of latecomers to the party piling into the market, and investors start to get complacent. So the essence of the report was really just to say that yes, the market is up, but the market can decline. It has declined, and it has declined dramatically in the past. And it is a good idea that investors prepare for a decline, and a preparation for a decline does not necessarily say the market will decline. But in case the market does decline, what is your plan? What is your exit strategy? Do you even have one, or did you just buy a bunch of stocks and you have no exit strategy? And if the market drops 44% over the next couple of months, you are just going to ride that down, because markets can drop dramatically. During 1987, we saw that the market dropped 22% in one day, and in 2 weeks, it was down over 44%. In 2008, we saw the market drop over 60% in the financial crisis, and 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 investors who did well during that period of time were investors who were prepared, investors whose portfolios were structured that a strong decline wouldn't wouldn't be a bad thing for them, because investors are of this view and have this myth that if the market is declining, that means your portfolio must decline. That is something that has been perpetrated by the mainstream financial industry. If a market is going down, that does not necessarily mean your portfolio should follow suit. A properly structured portfolio will cut losses in case of a decline, and either going to cash or going to other asset classes that may be increasing at the time. So the 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 essence is, don't get complacent. The lesson is, don't get complacent. And when you see some of these reports, etc., it's not necessarily fear mongering. It's just being prepared. Just like someone's wearing a seatbelt. It's in case of an accident, and that's why cars are fitted with airbags, etc. In case of an accident, it's not because it's not saying, the car manufacturer is not saying an accident will happen immediately, and if you go on the road tomorrow, you're going to crash. But in case of an accident, you have safety measures. And unfortunately, a lot of investors, their portfolios are structured that there are no safety measures in place whatsoever, and they are vulnerable to a decline. And that is why you see during these financial crises, you hear in stories about investors, their portfolios down 60, 70, 80, 90% from the highs that were made. And that can really obliterate retirement accounts and and just be devastating for your investments. So that is the difference between fear mongering and complacency. And just because someone says something, don't just dismiss it out of hand. Because at the end of every bull market, we have this call that if you point something out, that you are fear mongering, etc. If you want some more information about uh, how to achieve portfolio gains in any economic environment, or regardless of what stocks are doing, you can go to smartinvestorcentral.com and download that free report. It's a very good watch. It's a video report, and it lays out in great detail how to structure yourself to prepare for bull markets and bear markets, maximize gains in bull markets, and also position your portfolio for gains in bear markets also. That is the main takeaway from today. Okay, thank you very much for listening to this week's edition of the Smart Investor Podcast. I'll be back again next week, or if we have some sudden market event, I will do a special podcast. Thank you very much for listening, and I hope you have a wonderful day.